could be that the market crashes and your policy doesn't perform well. Very, very possible scenario. Not likely, because the market index usually historically goes up and down, and they factor that into the illustrations. We try and be as conservative as we can on the illustrations. However, there's risk in those because you're forfeiting the guarantees. The zero is a guarantee. You're not getting there's a chance you could get no growth at all. Okay. But the second downside of an IUL or a universal life, both of these, is that there's a surrender fee inside. I guess there's a third. The third is that the costs of insurance go up over time, but that's true with most policies anyways. But the surrender schedule, and this is important to let clients know about. These are long-term plans. If you have a client that wants an indexed universal life, okay, first of all, they need to be funding it adequately. They need to overfund it. I use $10 per decade or $100 per decade. So if you're in your 20s, $200 at least, 30s 300, 40s 400, and so forth, at least, because just as a general rule of thumb, that didn't come from anywhere, it's just been my observation. If you're 50 and you're funding your IUL at $120 a month, you might as well get a term policy. It's not going to last. It's not going to be enough to sustain it. An IUL has to be well funded.